revenues on this project as we currently have it designed, and I don't think that design will change, is somewhat on the order of about $350 million a year. And the net income after taxes, and I'm talking about Cameroon taxes, is on the order of $100 million to $140 million a year. So it does throw out a good after-tax cash flow and will provide, now again, this is 100% of the project of which we have 60.5%. So in other words, we would have $60, $70 million of cash flow when this gets up to design capacity.
And that would be assuming cobalt prices in the low 20s?
About $20, $22 a pound. And we believe that is a fair price. The fact of the matter is, for many years, we've always said cobalt was going to average $20 a pound. And a lot of people said, oh no, it's going to be 10 to 12 to 14 or so forth. Every single year that's gone by, it's averaged $20 a pound, and we don't see that changing in the foreseeable future.
Well, there's a lot of, how many companies are out there that actually produce cobalt right now that are publicly traded at all? Are there a lot of companies on the market?
There's only 2 producers in the world right now that produce cobalt as a primary product. One of them is in Angola and the other one is in Morocco. There's another Canadian junior company that's developing a project near Salmon, Idaho. They will be producing about 1,500 tons of cobalt per year. They are publicly traded. It has a 10-year, 12-year mine life. Those are the primary producers. The other 95% of the cobalt is produced from byproducts of copper and nickel mines, and roughly equal. So, I mean, when you have cycles in copper, where if copper production goes down, cobalt production is going to go down also, and the same thing can happen in nickel. And every now and then you do have these cycles in any metals where they happen at the same time, and as I say, when that occurs, we print money.
Does figures you gave include the nickel and magnesium?
Yes. Because, you know, when we first did the feasibility study in 2007, we did not include manganese as a byproduct. We knew it had a margin, but we were focused on the cobalt and nickel. Then we added that. Now we've added several other improvements, processing and concentration and the mining that we discussed earlier about saving money. So there's a lot of new technologies that we're injecting into this project to make it better.
Dave, I've got one final question. You pointed out the bear tracks. Which one of you 3 is the geologist and which one of you is the promoter of the 3?
Well, those 2 guys are geologists. I'm a mining engineer, and the 3 of us are promoters.
Do your projections include debt service for your loans?
Those projections I just gave you now, those are based on 100% equity basis. That would be reduced by the amount of loans that we have to service.
How much, what's your projection?
Well, I mean, if we get $300 million in debt, we get that cash flow coming in, and then we pay that out. The only thing that's really going to be detracting from that is the interest payment, the debt service. So if you're looking at $300 million and you're looking at 8% per year, you're looking at $24 million a year in debt service.
And of course, you'll have less equity dilution if you don't have to raise the equity. So it probably should offset.
Well, that's right, because we've levered this project. In other words, right now we look at about a 33% internal rate of return. That's based on 100% equity basis. When you go to a debt component in there, say 60%, then that return on equity, or the internal rate of return, will increase substantially.
Did you get? Well, you described the total of 300 million in rough terms. You said that your percent is 60-some% of that, right?
Well, the way that would work, if you have let's just say a $400 million project, for example. If we raise $300 million in debt, then that is applied to Geovic Cameroon, totally. The recourse to that loan is to Geovic Cameroon. The other, in that example, the other $100 million, we would be responsible for $60 million, and our Cameroonian minority shareholders would be responsible for $40 million. So the debt would go to the whole project. The equity goes to the shareholder ownership of Geovic Cameroon.
I was just trying to calculate a bottom line annual, not revenue, but profit after the debt service has been taken out.
Well, I mean, you're looking at a debt service period typically of about 8 years. So after 8 years, that decline in balance means the interest we're paying. The very first year, yeah, we're going to pay 8% on whatever we borrow. And but as we pay that loan off, within 8 years, that goes to zero. So if you're paying say 24 million or so in interest, and you're making 120 million or 124 million, then that means you wind up with essentially $100 million after debt service. So this project does throw off a very robust cash flow.
But your 40 million you were talking about before, you were estimating 40 million for debt service.
Right, no, that would be, I mean, before debt, I mean, that equity is just the ownership in Geovic Cameroon.
I guess the question is, you know, 4 years down the road, if you had debt, 24 million in debt service, and if the only going to work, what's your price per share, assuming you still have 100 million shares out? What's your earnings per share or cash flow per share?
Well, if you're looking at $100 million a year, and let's assume after taxes and after debt service, let's assume that, and you have 100 million shares out. Now, at that time, we may have 200 million shares out, who knows? But if you've got $100 million, now 60% of that is ours. So you've got $60 million, and you've got you got $60 million that comes to us. And then when you look at 200 million shares outstanding, that would be earnings of $3, or pardon me, 30 cents a share. And if you had a PE ratio of 10, you'd be looking at $3 a share. Okay?